scenarios. Let's first think about it in terms of Excel, because that's just the transparent way to think of it. Because these are somewhat complex transactions, especially if we add inventory, which we will do, just to think about the more complex scenario, and then you can reverse that if you don't have inventory. So what happens when we record an invoice with inventory? We've got the sales side, accounts receivable would go up. We're going to say in this case by the 167.40. The other side's going to go to income. We're going to say by the 155, and then we're going to imagine that we had sales tax, which is going to be a payable. That's going to be a consumption tax. That would be the revenue side of the transaction. And then if there's inventory is going to go down by the 100. We're going to imagine here, and then the expense of cost of goods sold is going to go up, so that we're going to have net impact on net income is the revenue, not including sales tax, minus the cost of goods sold. Now, what if they then return the merchandise before they paid for it? So we haven't actually got the money. It's in accounts receivable. Well, then I could just say, maybe you might say, well, I would just delete the invoice. Well, you don't want to delete the invoice because then we lose the audit trail. So what I want to do is say, I'm going to keep the invoice and then basically do something similar to, say, voiding a check, where I create another form in essence, which is going to give me the audit trail, in this case, reversing the transaction. So when we think about the transaction related to a credit memo, what you want to do if this came up on a test question or something like that, what would be the transaction for a credit memo? Well, what you want to do is record the transaction for an invoice and then reverse it. Now, normally when we reverse something, you in a book problem, you would have the debits on tops and the credits on the bottom, because that's just a convention. But typically when you're thinking about it in your mind, you don't want to shuffle up the accounts over here. I'm just going to think of the same order of accounts, top to bottom, and just reverse the debits and credits, or you can think of them as increases and decreases. So in other words, accounts receivable went up or was debited. So we're going to say the credit memo is going to take accounts receivable down. The income went up or is credited. So these are debits and credits. The negative represents an increase in a credit direction. In this case, I know that can be a little bit confusing, but there's that. And so we're just going to say the income account is going to be reversed. We're going to decrease it. That's the funny account. Why did I make it yellow here? Because normally we don't like decreasing the income account. We would rather make another account possibly, which would be a contra income account called sales returns and allowances. We'll talk more about that in a second, but let's keep going. The sales tax went up with a liability of a credit, so we're going to take it back down with a debit. The cost of goods sold and expense account went up with a debit, so we would take it down with a credit. The inventory account went down when we sold it with a credit, so we're going to make it go back up with a debit. So I know the debit and credit talk and the up and down talk gets a little bit confusing. I don't want to get into that in too much detail right here, but that's the general idea. So if I record this, we're going to say accounts receivable went up by that amount. It's going to go back down when I issue the credit memo. We're just going to say the income was recorded. Now, the income might have been recorded in a prior period and then has rolled into the equity section, which is basically what we're saying here, right? The income of that 30,055 is now in equity. So if the credit memo happened in the next period, the equity section would be reflecting it. And then we're going to say now income is going to go, we're going to say income is going to go down with the 155 on a debit. And then the sales tax payable went up last time in the credit direction of 1240. It's going to go back down. And then the inventory here went up last time. It went down last time. It's going to go back up. And then the cost of goods sold went up, and now it's going to go back down. So this looks funny because it looks like an increase here, but this is actually income going down in a debit direction and expenses going down. So this net income, this minus this $55, is actually net loss that has happened. All right. Now, one variant on this is we'd say, hey, look, I don't like to decrease the income account because it results in this negative income number, which is not negative here in terms of signs, but it's a debit balance account from debit and credit standpoint, and it should be a credit balance. account because it usually goes up with a credit. So we're just going to replace the income account with sales returns and allowances. So I'm going to say, okay, what I'd like to do is say, do the same thing. Accounts receivable is going to be reversed. Sales is going to be, it's not going to go to sales. It's going to go to sales returns and allowances. So now revenue account is only going to go up. And then I've got what we could call a contra revenue account, sales returns and allowances. It's contra revenue because it would be in the revenue section, not the expense section, but acts like an expense because it only goes in one direction, which ultimately decreases net income. And then we've got the sales tax would be the same. Everything else would be the same. And then cost of goods sold. Now notice you could make the same argument for cost of goods sold and expense account, which is going the wrong way. But typically we don't make a contra account for the cost of goods sold. We just reverse it. So it does something a little bit unusual for an expense type of account. And so there we have it there. And then you could have a scenario where you have a bad debt situation where accounts receivable is going up and you just simply want to say, hey, look, we're not going to collect on that receivable. So I have to get rid of the accounts receivable, and maybe you can use a similar kind of process to basically enter, in essence, a credit memo to record the accounts receivable, decreasing the accounts receivable on the other side going to bad debt when you determine a debt is no longer collectible. All right, so let's first do this scenario. So we do the invoice and then we'll reverse it.